Good afternoon, everyone. My name is Brian McSwain, and this is Modern Portfolio Theory, Understanding Risk, Return, and Diversification, prepared for Finance 828, Theory and Research. Let's begin. Today, we will be examining Modern Portfolio Theory, or MPT for short. This theory is a cornerstone in the field of finance and provides a crucial framework for constructing investment portfolios. Modern portfolio theory was developed by Harry Markowitz in 1952. At its core, MPT emphasizes the benefits of diversification. Diversification means spreading your investments across various assets to reduce risk. By doing so, you can potentially achieve higher returns without increasing the level of risk. MPT has significantly influenced the way financial professionals approach investment strategy and portfolio management. It provides the tools and concepts needed to balance risk and return effectively by helping investors make more informed decisions. Throughout this presentation, we will explore the historical background of MPT, its core concepts, practical applications, as well as criticisms and recent developments. By the end, you should have a solid understanding of why MPT remains a vital part of contemporary finance. Harry Markowitz introduced the modern portfolio theory in his seminal paper titled Portfolio Selection, which was published in 1952. This work laid the foundation for a systematic approach to investment by emphasizing the importance of diversification and the quantification of portfolio risk. The key contribution of Markowitz's theory was the concept of reducing risk through diversification, essentially meaning not putting all of your eggs into one basket. By constructing a portfolio of various assets, investors could lower the overall risk without necessarily reducing expected returns. Markowitz's groundbreaking work did not go unnoticed. In 1990, he was awarded the Nobel Prize in Economic Sciences for his pioneering contributions to the theory of financial economics and portfolio selection. This recognition underscores the profound impact of his work on modern finance. Moving on to the core concepts of modern portfolio theory. A portfolio is defined as a collection of investments held by an individual or institution. This can include a variety of asset types such as stocks, bonds, and real estate. In MPT, the concepts of risk and return are central. The expected return is the mean of the distribution of the possible returns for a given investment or portfolio. Risk, on the other hand, is measured by the standard deviation of these returns, which quantifies the amount of variability or volatility. A key principle of MPT is diversification, which allows spreading investments across different assets to reduce risk. By doing so, investors can potentially lower the overall risk of their portfolio without necessarily sacrificing expected returns. The idea is that the negative performance of some investments can be offset by the positive performance of others. These core concepts of portfolio, risk and return, and diversification form the foundation of modern portfolio theory and are essential for understanding how to construct and manage investment portfolios effectively. The efficient frontier represents the set of optimal portfolios that offer the highest expected return for a given level of risk. It is a visual representation of the trade-off between risk and return in portfolio management. To construct the efficient frontier, we plot various portfolios on a risk-return graph. Portfolios that lie on the efficient frontier are considered efficient because they provide the maximum expected return for a given level of risk. Conversely, portfolios below the efficient frontier are suboptimal because they offer lower returns for the same level of risk. Portfolios on the efficient frontier dominate those that are not. This means that for any given level of risk, an investor can achieve a higher return by choosing a portfolio on the frontier. Another important concept is the tangency portfolio, which is where the capital market line, or CML, touches the efficient frontier. The CML represents portfolios that optimally combine a risk-free asset with the market portfolio. The tangency point signifies the optimal mix of risky assets. Understanding the efficient frontier helps investors identify the most efficient portfolios, enabling them to make better investment decisions by balancing risk and return. The risk-return trade-off refers to the principle that potential return rises with an increase in risk. Investors aim to maximize returns while minimizing risk, but achieving this balance requires careful consideration and strategy. One way to manage this trade-off is by including a risk-free asset in the portfolio. The risk-free asset is typically a government bond or another investment with virtually no risk. By combining this risk-free asset with a portfolio on the efficient frontier, we create the capital market line. The CML represents portfolios that offer the best possible return for each level of risk. An essential tool for evaluating the risk-return trade-off is the Sharpe ratio. This measure of risk-adjusted return is calculated by taking the difference between the portfolio return and the risk-free rate, and then dividing by the standard deviation of the portfolio return. A higher Sharpe ratio indicates a more attractive risk-adjusted return, helping investors identify better performing portfolios. Understanding and managing the risk-return trade-off is fundamental to effective portfolio management. By using tools like CML and Sharpe ratio, investors can make informed decisions that align with their risk tolerance and return objectives. Let's now look at some of the practical applications of modern portfolio theory in the world of finance. MPT is highly influential in the formulation of investment strategies. By helping investors understand the relationship between risk and return, MPT guides them in creating diversified portfolios that can manage risk and optimize returns effectively. One of the key applications of MPT is in asset allocation, which involves deciding how to distribute investments among different asset classes such as stocks, bonds, and real estate. Asset allocation is crucial because it significantly impacts the overall risk and return of a portfolio. In today's digital age, portfolio optimization tools and software have become essential. These technologies use advanced algorithms to apply MPT principles in real time, helping investors to construct and manage their portfolios more efficiently. There are numerous real-world examples and case studies that illustrate the application of MPT in financial institutions and individual portfolios. For instance, many investment firms use MPT to design mutual funds and retirement plans that aim to achieve the best possible returns for their clients given a certain risk level. Modern portfolio theory is not without its criticisms and limitations. One significant criticism revolves around the assumptions made by MPT. The theory assumes that investment returns follow a normal distribution. In reality, returns often exhibit fat tails and skewness, meaning that extreme events, both positive and negative, are more common than a normal distribution would suggest. This can lead to underestimating the risk of extreme market movements. Another assumption is that investors are rational and make decisions based on mean variance optimization, aiming to maximize returns for a given level of risk. Behavioral finance research has shown that investors are often influenced by cognitive biases and emotions, leading to irrational decision-making. For example, investors might overreact to market news or exhibit overconfidence in their predictions, resulting in suboptimal investment choices. A further limitation of MPT is its reliance on stable correlations between asset returns for effective diversification. During periods of market turmoil, correlations between asset classes tend to increase, all while diminishing the benefits of diversification. This means that in times of crisis, a diversified portfolio may not provide the level of protection that MPT suggests. While diversification can reduce unsystematic risk, it cannot eliminate systematic risk, which affects all investments. Behavioral finance perspectives also challenge MPT. Investors often exhibit biases such as overconfidence, loss aversion, and herd behavior, which can lead to poor investment decisions. Loss aversion for instance, may cause investors to hold on to losing investments for too long or sell winning investments too quickly. Market anomalies such as momentum and the value effect contradict the efficient market hypothesis underlying MPT. Looking forward to recent developments and alternatives, one significant advancement is postmodern portfolio theory, or PMPT. PMPT extends modern portfolio theory by considering asymmetrical returns and focusing on downside risk rather than overall volatility. This provides a more comprehensive assessment of risk by emphasizing the potential for negative returns, which is often a primary concern for investors. Another important development is the Black-Litterman model. This model integrates investor views with market equilibrium to generate more stable portfolio allocations. By incorporating subjective insights along with objective data, the Black-Litterman model helps in creating portfolios that are better aligned with market expectations and individual investor beliefs. The impact of technology and big data on portfolio management cannot be overstated. Advanced algorithms and data analytics have revolutionized how portfolios are optimized and risks are managed. These technologies enable real-time adjustments and personalized investment strategies, enhancing the ability to respond to market changes swiftly and effectively. These developments and alternatives highlight the ongoing evolution in portfolio theory and practice. By addressing the limitations of MPT and incorporating new insights and technologies, investors can achieve more robust and adaptive investment strategies. In conclusion, modern portfolio theory provides a vital framework for constructing investment portfolios by focusing on maximizing returns for a given level of risk through diversification and the efficient frontier. MPT has practical applications in investment strategy formulation, asset allocation, and portfolio optimization. However, it is not without its criticisms, such as assumptions about normal returns, rational investors, and issues with correlation during market stress. Behavioral finance also challenges the rationality assumption of MPT. Recent developments like postmodern portfolio theory and the Black-Litterman model offer enhancements to traditional MPT. Despite these criticisms, modern portfolio theory remains a cornerstone in finance, essential for understanding and managing risk and return in investment decisions. Thank you.